In today's video, we're answering the question, why do companies buy back stock? Which is also referred to as share repurchasing. They both mean the same thing. And guess what? If you like receiving dividends, then you're gonna love learning about why companies buy back stock, so you're in for a treat. And on that note, you might actually be surprised by the similarities between a company paying dividends and a company buying back their stock. So I'm about to show you a comparison chart that's gonna blow your mind, and I can say that because it blew my mind when I first saw it. Not only that, but what I'm about to show you was something that has strongly contributed to my personal success with long-term stock investing, and really just knowing what to look for when it came to picking companies to invest in general. So what you're looking at here comes from the book The Outsiders, and this graph shows the performance over time as a multiple of the performance of the S&P 500 over that same time for the CEO Jack Welch, and then the average of the 8 CEOs that are detailed in this book. Jack Welch is included here to really just give contrast and show us just how much better these 8 CEOs did. He was the CEO of General Electric from 1981 to 2001, and many people would say that he was the best CEO of the past 50 years. If you invested $1 in GE stock when he took over as CEO, it would have turned into $48 by the time he passed the job on to his successor 20 years later. In other words, a compound annual return of 20.9%. In contrast, if you had invested $1 in the S&P 500 instead, over that same time period, your dollar would have grown to just $13.74 with its annual growth rate of a still respectable 14%. By the way, that really goes to show how big of a difference there is between 14% and 21-ish%. Nonetheless, this line here represents the average of the 8 CEOs that are detailed in this book. Although this chart extends out 25 years, since we've been making the comparison using the 20-year mark, I can tell you that with using the average of these 8 CEOs, your dollar would have grown to around $340 after 20 years. Success leaves traces, as legendary investor John Templeton says. And these CEOs all had a handful of things in common, one of which had to do with share repurchasing. Listen, not only did these 8 CEOs decimate the results of the S&P 500, they also destroyed their industry peers. This chart here now shows how they did compared to their peers, and you can see that it wasn't just that they happened to be in a good industry. Nope, not at all. Share repurchasing, aka stock buybacks, was one of the things that they had in common, yes, and I will share with you the other things they had in common as well in just a second. However, not all share repurchasing is good. As Warren Buffett said in his 2000 shareholder letter, there is only one combination of facts that makes it advisable for a company to repurchase its shares. First, the company has to have available funds, cash plus sensible borrowing capacity, beyond the near-term needs of the business, and second, find its stock selling in the market below its intrinsic value, conservatively calculated. As amazing as stock buybacks can be for accelerating returns, they also have the ability to do the exact opposite. Or in other words, they can be extremely destructive to shareholder value. By the way, you're not going to want to miss the bonus tip at the end of this video because I'm going to show you an easy way of knowing what type of company you're looking at so you can avoid investing in the ones that are using stock buybacks poorly and basically aren't acting in the way that these 8 powerhouse CEOs that were outlined in this book have done things. Alright, so now I'm going to tell you what happens when a company buys back stock and why they do it, the good and the bad. The ownership of public companies is divided up into shares. Each share represents a share of the company's ownership. If you own 1% of the shares outstanding, then you own 1% of the company. If you own 5% of the shares outstanding, you own 5% of the company. Simple as that. When a company buys back its own stock, those shares become retired and the total number of shares of the company's ownership is divided amongst is reduced, making each individual share more valuable because now each share represents a little bit more of ownership than it did before. Let's look at an example. Let's use simple numbers and let's just say that you own 100,000 shares of a company's stock and that this 100,000 shares represents 5% of the shares outstanding and therefore means you own 5% of that company. This would therefore make the total number of shares outstanding 2 million. And let's also say that this company currently produces $1 per share of earnings. So as a whole, it means that this company makes $2 million. And since you own 100,000 shares, it means that your piece of the annual earnings is $100,000. This $100,000 that you're entitled to as 5% owner does not go directly into your pocket, unless of course the CEO decided that the best use of that money is to distribute it all out as a dividend, in which case it would go into your pocket. And if that were the case, you'd actually end up only pocketing around $75,000 after paying paying taxes on that income. And you could use that $75,000 to purchase more shares, thus increasing your ownership, or you could reinvest it elsewhere if there was another investment opportunity that you liked even better at the time. However, let's say that the company, instead of distributing the earnings, uses them to buy back shares of its stock. Let's say now instead that with that $2 million, they were able to purchase on the open stock market exchange 400,000 shares. Those shares would therefore now be retired, and ultimately the total number of shares outstanding would be reduced to 1,600,000. Now you still own your 100,000 shares, which means that you now own 6.25% of the company. Not bad. Your ownership of the company has increased by about 25%. Wow. Which also means that you're entitled to 25% more of the future earnings of that company. The intrinsic value of each share has naturally increased, and soon the stock market will recognize that increased value and begin to price the shares in a way that reflects that increased value accordingly. Next year, if the company makes the same amount of money, $2 million, then earnings per share would now be $1.25. And that comes from $2 million of total earnings now being divided by 1.6 million shares outstanding. So if we multiply that $1.25 by the 100,000 shares that you own, it equals $125,000 of those earnings are attributable to you because of your ownership. So that's cool, and it's also tax efficient as well. For one, you didn't pay any taxes in the same way you would have if those earnings were distributed to you as a dividend. And secondly, as a bonus, when it comes time to sell your shares, capital gains taxes happen to be lower than dividend taxes, so it's a double win. And ultimately, the less money that's being eaten up by taxes, the stronger and the faster your capital can compound. Now look, before you go run out and buy stocks of companies that are known to repurchase shares, let me explain when it can be a bad thing, and then why a company would ever buy back their stock at a bad time. Remember, Warren Buffett is enthusiastic about share repurchasing only if his two criteria are met. One, that there's funds available for it, and two, that the stock is trading at a price below its intrinsic value, conservatively calculated. Otherwise, if these criteria are not met, then it makes this whole stock buyback thing actually destructive to shareholder value. Let's go back to our previous example for just a second, and I want you to notice how earnings per share went from $1 per share to $1.25 per share in the following year, even though the company made the exact same amount of money, $2 million. Yeah, it's really easy to prop up that earnings per share figure by simply buying back stock, even if the company as a whole hasn't actually earned any additional cash to speak of. And because earnings per share is what Wall Street analysts focus on so intently, and because some CEOs like to please Wall Street, those CEOs might be so inclined to buy back a little bit of stock here and there in order to beef up that earnings per share figure and meet Wall Street's expectations. Or even just to meet the earnings guidance they've previously provided to Wall Street if they're going to come in a little bit low. In fact, it's not unheard of for a company to buy back stock at crazy high premium prices in order to beef up the reported earnings per share, and still all the while fully believing that they're doing it in the best interest of shareholders. Not only that, but CEOs whose bonus checks are tied to meeting certain earnings per share milestones are financially incentivized to buy back stock and beef up that earnings per share figure regardless of how high a premium the shares are currently trading at, so that they can collect that bonus check. Let's go back to our previous example for a second. Remember we said that the $2 million allowed our example company to buy back 400,000 shares? So this meant that each share was purchased at an average price of $5. Remember, earnings per share was $1, so buying back at that price meant the company was paying 5 times earnings, aka a PE ratio of 5, aka an earnings yield of 20%. A 20% yield is good. Put it this way, if that cash was distributed to me as a dividend instead, there's a solid chance I would not have been able to find a better place to invest that money that would yield a return any higher than that, especially after paying the taxes on the dividend income first before I could redeploy that cash. As a shareholder, you'd actually be happy that the CEO capitalized on that opportunity and bought back shares when it was worthwhile to do so. However, if the shares were trading at such a price that $2 million only allowed them to buy back 50,000 shares, for example, that would mean that they would have been paying an average price of $40 per share while they were repurchasing. Paying 40 times earnings is not so great. That's a yield of just 2.5%, and I'm pretty certain that I could do better than that myself. And if that were the case, I'd much rather have those earnings paid paid out to me as a dividend because I would be able to find a much higher yielding investment opportunity for that cash. Here's your bonus and then we'll wrap up. CEOs have two jobs. One, to make sure that the operations run smoothly with their high-level management of the people. And then two, to figure out how to allocate the cash that the business generates in the most effective way. Most CEOs focus on that first side of things, and that's also what all the management books are written about. But it's the capital allocation part that really matters to you and I as investors. A CEO being a good capital allocator and a good investor is so important. The same company but run by different CEOs, a good capital allocator versus a bad one, will achieve wildly different results, especially over a long period of time. Case in point, the 8 outsider CEOs who destroyed the results of their industry peers. Now here's what they had in common, and this again comes from the Outsiders book. They all paid either no dividends or very low dividends. None of them provided Wall Street with any earnings guidance. And all of them, besides Berkshire, bought back 30% or more of their shares outstanding over their time span as CEOs. Now that's as of the time of this book being written, but guess what Berkshire's been doing lately? That's right, they've been buying back stock pretty heavily and pretty much for the first time in history. Look at what's been happening with Berkshire's shares outstanding over the past 2 years. So that's pretty cool for the owners of Berkshire Hathaway, myself and my girlfriend Stephanie included, and in his latest annual report he explains that this dynamic is likely to continue. Alright, now let me share the bonus tip with you on how to tell if a company is being run with good capital allocation in mind or not. What you want to do is you want to look at the shares outstanding over time and notice if the company has been repurchasing or issuing new shares at ideal times or not. So take a look, here's a company I like, NVR. NVR is a company that gets it. This is a graph of the shares outstanding in orange, and plotted against it is the PE ratio in purple. So the price per share isn't on this chart at all, just the number of shares outstanding over time and the PE ratio that the stock has been trading at historically over time. And what I want you to notice is how the shares outstanding has changed over time in relation to the PE ratio at that time. Notice how when the PE ratio was high, meaning the shares were trading at a high premium, NVR stopped buying back stock, and in fact they were often issuing shares at that time and raising cash while their stock was trading at a high premium. And then notice how at times when the stock was trading at a lower PE ratio, that they'd use that opportunity to buy back their shares while they were cheaper. So what you're looking at here is great. And if you saw the opposite of this, a company buying back stock while it was trading at a premium, or issuing new shares to raise cash while the stock was priced cheaply, then you can take that as a clear sign that the management either doesn't get it or just doesn't care, and ultimately isn't focused on increasing the per share intrinsic value of the stock in the way that you'd want them to be as a shareholder.